This question tests knowledge of short-term financing and the types of commercial bank loans used to finance seasonal working capital needs. Many manufacturers experience predictable fluctuations in sales during peak seasons, requiring additional financing to purchase inventory, pay employees, and support increased production before cash is collected from customers. Because the financing need is temporary, companies generally prefer short-term bank loans that can be repaid when seasonal cash inflows are received. The ideal financing source should match the short-term nature of the asset being financed. Students should distinguish between short-term working capital loans and long-term financing arrangements. Long-term loans are appropriate for purchasing fixed assets or financing permanent capital needs, while seasonal inventory and receivables are typically financed with short-term credit. A. Transaction loan. Incorrect. A transaction loan is designed for a specific financing need, but it is not the standard term used for seasonal working capital financing in this context, and is less appropriate than a short-term bank loan. B. Insurance company term loan. Incorrect. Insurance company loans are generally long-term financing arrangements used for permanent investments rather than seasonal working capital requirements. C. Installment loan. Incorrect. Installment loans involve periodic principal repayments over several years and are more appropriate for financing long-term assets such as equipment. D. Unsecured short-term loan. Correct. Seasonal financing needs are temporary, so an unsecured short-term loan from a commercial bank is the most appropriate source of financing. It provides working capital during the busy season and can be repaid as seasonal sales generate cash. Correct answer. D. Unsecured short-term loan. Exam tip. Apply the matching principle of financing. Temporary current assets should generally be financed with short-term debt, while permanent assets should be financed with long-term capital. Seasonal inventory buildups and temporary increases in receivables are classic examples of financing needs best met through short-term commercial bank loans or lines of credit, making unsecured short-term borrowing a common solution for financially sound companies. This question tests knowledge of commercial bank financing products, an important topic in working capital and short-term financing management. Commercial banks provide a variety of lending arrangements to help businesses finance both short-term operating needs and longer-term investments. The four financing methods listed are all commonly associated with commercial banking. Discounted notes. The bank deducts interest in advance and provides the borrower with the remaining proceeds. Term loans. Loans with specified repayment schedules, often used for equipment purchases or longer-term financing needs. Lines of credit. Flexible borrowing arrangements that allow firms to borrow up to a predetermined limit when funds are needed. Self-liquidating loans. Short-term loans that are repaid from the cash generated by the assets they finance, such as inventory or accounts. Receivable. The question asks which of these financing options a commercial bank is likely to offer. Since all four are recognized banking products, the correct answer includes every item listed. I. Discounted notes. Correct. Commercial banks frequently provide discounted loans in which interest is deducted before the borrower receives the funds. 2. Term loans. Correct. Banks commonly make medium and long-term loans with scheduled principal and interest repayments. 3. Lines of credit. Correct. A line of credit is one of the most common forms of commercial bank financing for working capital needs. 4. Self-liquidating loans. Correct. These loans finance short-term assets such as inventory and are repaid as those assets are sold and converted into cash. A. 1 and 2. Incorrect. This omits lines of credit and self-liquidating loans, both of which are common commercial banking services. B. 3 and 4. Incorrect. This excludes discounted notes and term loans. C. I. 3 and 4. Incorrect. This omits term loans, another standard bank financing product. D. 1, 2, 3, and 4. Correct. All four financing methods are commonly offered by commercial banks. Correct answer: D. 1, 2, 3, and 4. Exam tip: commercial banks provide a wide range of financing products, including short-term credit, lines of credit, discounted notes, self-liquidating loans, and longer-term financing, term loans. Remember that banks tailor financing to match the borrower's operating and investment needs, making all four instruments common features of commercial lending. This question tests knowledge of hedging strategies using derivative instruments, specifically the distinction between fair value hedges and cash flow hedges. Companies often use futures contracts to reduce the risk associated with changes in commodity prices, interest rates, or foreign exchange rates. In this case, the company buys a wheat futures contract to protect against future fluctuations in the price of wheat, which it expects to purchase later. The objective is not to protect the current value of an existing asset, but rather to stabilize future cash payments for purchasing wheat. A cash flow hedge is designed to reduce uncertainty in future cash flows resulting from changes in prices, interest rates, or exchange rates. By locking in the future purchase price of wheat through a futures contract, the company reduces the risk that rising wheat prices will increase its future cash outflows. In contrast, a fair value hedge protects the current value of an existing recognized asset or liability. The wheat purchase has not yet occurred, so there is no existing asset whose fair value needs protection. A. Fair value hedge. Incorrect. A fair value hedge protects the value of an existing asset or liability already recognized on the balance sheet. It does not normally apply to a planned future purchase of inventory. B. Cash flow hedge. Correct. The futures contract protects the company against changes in the future cash outflow required to purchase wheat. This is the classic example of a cash flow hedge. C. Foreign currency hedge. Incorrect. Foreign currency hedges manage exchange rate risk arising from international transactions, not commodity price risk. D. Swap. Incorrect. A swap is a different type of derivative contract used to exchange cash flows, such as interest rate or currency payments, and is not the instrument described here. Correct answer: B. Cash flow hedge. Exam tip: a simple way to distinguish hedge types is: fair value hedge equals protects the value of an existing asset or liability. Cash flow hedge equals protects future cash inflows or outflows from expected transactions. Because purchasing wheat is a forecasted future transaction, using a wheat futures contract to lock in its price is classified as a cash flow hedge. This question tests knowledge of corporate restructuring and divestiture strategies, specifically identifying which transaction generates cash for the corporation. Companies may restructure by selling assets, distributing subsidiaries, changing their capital structure, or repurchasing shares. The financial impact differs depending on the type of transaction. An equity carve-out occurs when a parent company sells a portion of a subsidiary's shares to outside investors through a public offering while retaining control of the subsidiary. Because investors purchase the shares, the parent company receives cash proceeds from the sale. In contrast, a spin-off distributes shares of a subsidiary directly to existing shareholders without raising cash. A reverse stock split merely changes the number of shares outstanding and their price proportionally, generating no cash inflow. A stock repurchase requires the corporation to spend cash to buy back its own shares. Therefore, only the equity carve-out provides an immediate cash inflow to the corporation. A. Equity carve-out divestiture. Correct. In an equity carve-out, the company sells part of a subsidiary to public investors and receives cash proceeds, while often retaining a controlling interest. B. Reverse stock split program. Incorrect. A reverse stock split changes the number of shares outstanding but does not generate cash for the corporation. C. Spin-off divestiture. Incorrect. A spin-off distributes subsidiary shares to existing shareholders without selling them, so no cash is received. D. Stock repurchase program. Incorrect. A stock repurchase requires the company to use cash to buy back its own shares, resulting in a cash outflow rather than an inflow. Correct answer: A. Equity carve-out divestiture. Exam tip: distinguish among common restructuring transactions. Equity carve-out raises cash by selling subsidiary shares to the public. Spin-off distributes subsidiary shares to shareholders with no cash received. Reverse stock split changes share structure only. Stock repurchase uses corporate cash to buy back outstanding shares. Remember that only transactions involving the sale of ownership interests to outside investors generate cash inflows for the company.